Hi, I'm David Stein of Money for the Rest of Us, and in this video I share 4 investment lessons from Warren Buffett. In the 2017 Berkshire Hathaway annual letter, we learned some important investment principles from Warren Buffett. The first is to use debt prudently. Buffett writes, investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date. Now, that's what investing is. You don't spend today, you invest the money, and hopefully you can spend more in the future. Debt is the exact opposite of that. There we're taking future consumption and moving it into the present by spending the borrowed money. There's risk in doing that. While Berkshire Hathaway uses debt in terms of potentially in the reinsurance business, as individuals we should be cautious when we use debt. Certainly not using it to buy consumer goods, like say to go on vacation. Perhaps we use some debt prudently for education, maybe a car or a house. But we shouldn't use debt as part of our investing because we can't get the low interest rates that Berkshire Hathaway can. If we get a margin loan, it might be at 6 to 8%. And most investments aren't going to return that type of, at least the guaranteed that type of return. And so if the investment happens to fall, we'll get a margin call. And we can't be patient investors when we use leverage in our investing. The second investment lesson from Warren Buffett's annual letter is keep your eyes open. Buffett writes, markets occasionally do crazy things. And what investors need is an ability to disregard mob fears and enthusiasm and to focus on a few simple fundamentals. We shouldn't be scurrying around, which is sort of his third lesson, to stick with big, easy decisions and eschew activity or constant trading. So focus on simple fundamentals and focus on big, easy decisions. So what does that mean as an investor? Well, we should focus on the drivers of investment returns. What is the cash flow or the income stream from the investment? How fast is that income stream growing, and what are investors willing to pay? There are times when markets do crazy things, and investors will hardly pay anything for cash flow. So the valuation falls. So there's a level of fear in the marketplace. And at those times, we can make those big, easy decisions, perhaps to increase our investing. Buffett had a debt that he did with protege partners where he bet that the S&P 500, essentially the stock market, would do better than the hedge funds that protege partners picked. It was a 10-year bet. Buffett won. The S&P 500 returned 8.5% annualized over that 10 years. And the best of those hedge fund of funds that protege picked only returned 6.5%, and most returned less than 5%. And Buffett said he only had to make one decision. Didn't require insights or brilliance. Just one decision in 10 years to invest in the S&P 500. So we can keep our decision simple, not trying to chase every single opportunity that comes along, but focus on asset classes, things that we can value, things that have an income stream. Which his fourth lesson is to be willing to be early and look foolish. Because markets do crazy things, there can be sectors of the markets or asset classes that are very much out of favor. And when we see that the yield is attractive, that the valuation is low, we're never going to get the timing right. So when we make that investment, we can look foolish for a time. It takes patience. But ultimately, that patience can be rewarded if we have those fundamental drivers of income growth, and an attractive valuation. So hey, if you'd like to learn more about investing, check out my free email investment course. It's on how to invest, and you can get more information at howtoinvestmoney.co. If you have a question on this video, go ahead and leave that in the comments, and thanks for watching.